How's it, guys? Today's video will be about the unicorn model, which I call the unicorn entry confirmation model because it consists of two ICT concepts used in combination to confirm entry. The two concepts are one, the breaker block, and two, the fair value gap, which can both be used singular as an entry confirmation. So before going into the unicorn model itself, let's briefly discuss what is a fair value gap and what is a breaker. Okay guys, for those who have been following my channel for some time now, you all know that I have a video about fair value gaps and how to trade them and how to refine your interest at the fair value gap. So I'm not gonna go into much details here. So here I'm just gonna go into the basics of a fair value gap. So what is a fair value gap? A fair value gap is a consecutive candle pattern whereby the low of the first candle does not overlap with the high of the second candle. Right? We're talking bearish fair value gap. We have a low of the low of the first candle that does not overlap with the high of the third candle. The space in between is what's known as a fair value gap. Right? That's a bearish fair value gap. A bullish fair value gap is the opposite of a bearish gap, whereby you have the high of the first candle which does not overlap with the third candle. Space in between them, a fair value gap. The most important thing that you have to understand about fair value gap is a consecutive candle pattern, meaning one candle, two candle, three candle. And for there to be a fair value gap, the low of the first candle does not have to overlap with the high of the third candle, and vice versa. High of the first candle does not overlap with the low of the third candle. Right? If you want more information, go check out the video on fair value gaps on my channel, guys. Okay. Okay, guys. What is a breaker block? A breaker block is a structural pattern. It is a structural pattern whereby the market has a high here. Let's say the market has a high here, then the market makes a low, then the market makes a lower high relative to the low. Then the market comes and break this low here. The market comes and break this low. Why does it break this low? Because below every swing point in the market, or we have liquidity. So below this swing low here, there's liquidity. So the market will go start filling this liquidity. So this is our liquidity grab. Our liquidity grab. So the market after when the market is grabbing the liquidity, it makes a lower low. It's a lower low relative to this low because it's lower than this low. Then the market places to breaking this structure or breaking this high here. When this high is broken, we coin this as a break of structure. We have a break of structure here, and when this high is broken, we have a change in market structure. We have a market structure shift, a change in market structure. So what we know about this, we have a grab of liquidity by breaking this low, the market make a low, and it comes and make a lower low, breaking this liquidity. Then the market comes and make a high, breaking this high here. So this market structure shift signal to us that the market is ready to go down, it's ready to go up. So a breaker block is something. Where do you see a breaker block? A breaker block will form in between the leg of the high, the lower, the lower high, and the lower low. Somewhere in between here, it can be from up here. You must use a candle that was there before this low was taken. So if the down candle is down here, it's not a breaker block because it didn't occur before this low. It need to occur before this low was broken. So our break of structure can be from here and here. So when you refine it, you use a 50% or use the last down candle here before the broke this low. That's essentially what is a breaker block. Okay, now let's go into the unicorn model and see how we trade it. Okay, guys, with the unicorn strategy, what you look for is you wait for the market to make this high, then the market makes a lower low, then the market makes a lower high. It's a lower high because it's lower than this high here. So the market is this low, we have a break of structure here, or liquidity, we have liquidity grab down here. So and after this, after the market making a lower low, the market is upside and breaks the high and breaks the high. It breaks the high. Then we have a break of structure here. This is break of structure, and this is our market structure shift signals to us that the market is ready to change direction. That's why it's a market structure shift. Market structure is shifting bearish all the way to bullish. So what do we look for? See this market structure shift. Look for we come to the displacement low and the displacement high. We look for your discount and premium. I talk about discount and premium. I also have a video on my channel about discount and premium. So if you want to check it, go to my channel and check it out. It's so useful because it, discount and premium determines whether we are buying the market or selling the market, because common sense will tell you that you cannot buy something that is expensive and you cannot sell something that is cheap. You have to do the opposite. You must buy when something are cheap and sell when something are expensive, because you are looking to buy or looking for the market to replace to the discounted price for up. So what you do with the unicorn entry model is you look for your breaker block first, then you look for your fair value gap. Where is our breaker block? Our breaker block is here. This is our breaker block. Then you first look for your breaker block from here to here. Then you look for your fair value gap. Let's say you find your fair value gap here. Now this becomes your fair value gap. And this breaker block is too large. So for you to refine it is either you can leave it like this and use 50% of it, or better yet, look for the last down candle. The last down candle that's responsible for this break of structure. The last down candle is here. That is responsible for this break of structure before it's responsible for this break of structure. Then you use that candle there. Let's say the candle is here. So what you do, market into the either the 50% of the fair value or the 50% of the block. Then you take your long positions there. What you can hide your stop loss below, just below this low and target high. But if you want accuracy, you can then again come and take the 50% here, take out your fib, then look for your OTE, your optimal trade entry. Your optimal trade entry will tell you where you can take your first profit. This is your first profit. You can take your first profit there, and you had your stop loss below this low or below the break. Okay, simple as that, guys. So now that you understand the theory part of the breaker block or the unicorn model, let's go to the chart and look at a few examples. Okay, guys, bear in mind that I'm trying to keep this video as short as possible so that I can get straight to the point. So I'm not going to use market replay. Remember, what you're looking for is you're looking for something like this. You're looking for the market to make high, a low, a higher high, a lower low, then trace, then this is down again, right? So what we have here, we have the market here making this low. We have a low, we have a high, we have a high. Let me track it. We have a low, we have a high, we have a higher low, higher high, breaking structure here. Now we have this low here and displaced out. So the market is high. So we have this break of structure here. The break of structure here, because what, this is a swing low and a swing low counts as a break of structure. Then now we are looking for liquidity. A liquidity grab we find here. That's our liquidity grab. The market came above this relative equals, right? Our liquidity grab. Now we're looking for the market below this low. We're looking for the market to displace below this low. This is where our structure was displaced. This is where our market structure came to be, because this low is higher than this low. The market comes and is down, and if you check with the from can use the candle that look out this because low pattern is responsible for this break of structure. So if you want to refine it further, you can come and use it here. Now we have a breaker block here. We have breaker block here. You are looking for favor the second leg of the unicorn strategy. You find for the market into either the breaker block or the fair value gap. So if you are using you can use the open of the fair value gap, the 50% of the fair value gap, whichever one you prefer to use the 50%. So you take your position at the 50%, you hide your stop loss here above this swing high. It's a protected high, hide it above this high here also, because the market broke structure to the downside multiple times, so it has no reason to come up to this low. How to get target? Look for your discount and premium, guys. Discount and premium. Take your put it here, and you take out your 50%. This is equilibrium. Then PDR is in the discount market. This is your best level gap, which is equal lows here. Remember that this is a daily low and this is a daily low, so these are relative equal lows. So you can take your profit at the 50% of the fair value gap or the open of the fair value gap, guys. Or the fair value gap, guys. Just like that. The market taps you in, then at the first PDRA in the discounted market, that's where you buy back your position, right? Now let's go to the 1 minute and look at our last entry, our last example, I mean. Okay, guys, on the 1 minute, we have a structure like this. So if you can see here, we have consolidation of some sort here, consolidation here, consolidation here, but don't stress yourself about that. I'm still gonna make a video about the power of three. But we have this. The first thing out of the consolidation is the market breaks to the upside. We have a break structure to the upside. So we have this low. Now we know that the liquidity grab. We have liquidity grab here or liquidity sweep, whichever one you want to use. Then what are you going to look for? You're gonna look for the series of down candles that are responsible for the break of structure. So we have a down candle here. If you want to refine it much better, you can use this last candle here. This is your breakup block. It's a breakup block because we have a sweep of structure to a sweep of this liquidity and a displacement higher from here. We have a break of structure again to the side, signaling us the market might go up, and after that we have market structure shift. We have a market structure shift here. This is a confirmation that the market is going to shift even higher. So you can use this as an entry. This is in a discounted market. So you cannot. So you take your flip, you put it to the low, to the high. And this is your equilibrium. You look for your PDA discounted market. So the first one is you can use the first one. I like to use the first one. Myself. You can use the first one or the last one. So what we have here is we have the market tapping into the fair value gap here and into the breakup block. So you take your buy positions here at the 50%. At the 50% of the fair value gap, it's here. Then let's see where you can target with your first target, your first partial, second target, third target, right? So you target here, then this is where you take your partials. After taking your partials, you move your stop loss into profit. What I mean into profit is this is a buy, so you move your stop loss above your buy position. And again, when you come here again, you can take another partial or close your position. And another position is another target can be when it comes here, you can take partials or close the position, or you can try and target this high point here. So that's it, guys. That's what the unicorn entry model is. It's a combination of a fair value gap and a breakup block, right? And both of them can be used independently. You can choose the fair value gap and trade that, and you can use the breakup block and trade that. But when you combine them together, you can increase your risk to reward rate ratio. Okay, guys, if you have made it this far into this video, please consider subscribing and liking this video for more videos. Till I see you next time.